Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So today we're going to be talking about the difference between investing and speculating. Some people think the stock market is this big gambling machine, and it certainly can be if you approach it the wrong way. Some people think that every stock you buy is an investment, and it's certainly not, again, if you approach it the wrong way. So I want to talk through the difference between speculating and investing, give you some examples of both, where I draw the line, where people like Ben Graham, father of value investing, and Warren Buffett tend to draw the line, and that should give you some good perspectives on which of your own investments kind of fall into each of those two categories. So that's the topic for today's video. Just before we get into that, I've got a question for you. So one of the few companies in my portfolio that I've sort of made public on this channel in the past is a company called Fiat Chrysler, and they recently had some pretty big news come out. So they are planning to merge with another car company called PSA Group. And when this news sort of officially came out just yesterday, the stock didn't move too much. But previous to that, a few weeks ago, when the initial kind of news came out about why this might be happening and what some of the terms and things might look like, the stock shot up about 15% in a matter of a couple of days. So it's pretty big news for the business. One of the other things that's happening is the company's probably going to pay out like a 25% special dividend, which is pretty unheard of. So yeah, a lot of cool things happening there. So basically my question is, do you want me to make a video on it? If so, let me know. Drop a comment down below just saying that you want to see the Fiat Chrysler PSA merger video. But for now, let's get into the topic for today's video, which is investment versus speculation. So this right here is The Intelligent Investor by Ben Graham. It's often called the Bible of value investing because it is really the original popular kind of text around what value investing is, how to think through buying businesses instead of buying pieces of paper and stocks that go up and down and so on. And the very first chapter actually is on the difference between investment and speculation. And Ben Graham gives us quite a straightforward sort of definition of what an investment is and what a speculation is. But it's quite nuanced, and there's little bits and pieces that you really need to understand when you put it into a stock market sort of investing context. So Ben Graham's definition of investing is something that provides safety of principle and an adequate return. And anything that doesn't provide those two things, he puts into the camp of a speculation. And basically anytime I say speculation through this video, you can interpret that or hear that as gambling, if you like, as well. If you're not super familiar with the term speculating, that is also what that essentially means. So that is the definition of an investment: safety of principle, adequate return. I want to dive into why you would be after each of those two things. They probably sound pretty obvious, but I want to talk through some of the basic maths in behind that as well, and then give you some examples of what I would view as an investment in the stock market versus a speculation in the stock market and in other markets as well. So let's dive into that. So first, let's talk about safety of principle, because that's something that not just Ben Graham, but pretty much every value investor under the sun will talk about a lot. And it comes back to some basic fundamentals. So Warren Buffett has this quote that's rule number one, don't lose money. Rule number two, don't forget rule number one. Phil Town wrote a series of books along that rule one investing kind of framework. And then you have guys like Mohnish Pabrai, which will say things like, focus intensely on the downside so that you can find bets in the stock market that are sort of these heads I win, tails I don't lose much scenario. So there's a lot of downside protection in those investments. And the maths behind it is pretty straightforward. So anytime you lose money on a sort of, if we put it into percentage terms, let's say you lose 50% on an investment and you have quite a bad experience, to get back to your initial level of principal, you actually need to make a greater than 50% return. So if, for example, you have $1,000 and that then goes down to $500, in order for you to get back to $1,000 from $500, you actually need to make a 100% return. You need to double that $500 to get back to $1,000. And that's something that a lot of value investors understand inside out. That's something they focus massively on. They realize that any step backwards means that you need to sort of go 2 steps forward just to get back where you started. So it's not a sort of linear relationship, I guess, between, that's probably not the correct mathematical way to say it, but there's not kind of the smooth relationship between losing money and then getting back to where you were. So immense focus on downside protection is huge with any investment. Ideally, you want that in every single investment. And that's the basic reasons why. The more often that you have mistakes and lose money, those things can pull down your rate of return and your long-term results very quickly. So that's safety of principle. Next, let's talk about part 2 of that quote, where Ben Graham is focusing on an adequate return. And I find it very interesting the way that he words this. Obviously, we want to make some sort of return. If we're putting money out into an investment, we want that money to grow, and we want to continue compounding along our sort of investment journey. But Ben Graham's searching for an adequate return. He's not searching for a 5x on his money in 6 months or anything crazy. He's not searching for an insane return. He realizes that over the long term, instead of trying to chase big short-term gains and having a high potential for loss, which, like we just spoke about, can set you back pretty aggressively, he's focused on compounding at a reasonable rate over a long period of time. So Ben Graham's a guy that would much rather compound at 8 or 10 or 15% a year over a long period of time and continually build and build and build. He would much rather have that set up than have these huge swings in his rate of return, than have, 1 year he triples his money and the next year it gets cut in half or anything like that. So he's looking for an adequate return. He's focusing on purchasing businesses at appropriate prices and all those sorts of things that we speak about all the time. So that is what Ben Graham is really talking about with an investment versus speculation. So that's a definition of both. I just want to run through some practical examples of each. I think it's easy to say a lot of this stuff and read off quotes and that sort of thing, but putting it out into the real world, I think, can be just as powerful a lesson as well. So I'm going to give you some examples of stocks that I think fall into the speculation category, some stocks that I think fall into the investment category. So let's talk about that. Okay, so for the speculations, I'm going to give you a couple of categories because the line can get a little bit blurry with some of these. The first one I'm going to call obvious speculations, and the second one I'm going to call potential speculations depending on price. So the obvious speculations, the first one I'm going to give you is Bitcoin. So I know there's a lot of Bitcoin fans out there and all that sort of thing. I've made videos on this before, and I just very quickly my thoughts on Bitcoin. I think blockchain technology has a lot of future applications and those sorts of things. Bitcoin, I don't know any way to calculate what it's really worth, and I don't think anyone does, to be perfectly honest. So that is exactly what makes it a speculation. So Bitcoin is a non-productive asset. It's not like a business that produces cash flow or a farm that produces crops or livestock or anything like that. That can be converted into cash flow. It doesn't produce anything, and therefore it is very, very tricky to calculate an intrinsic value for that Bitcoin, and it makes it a speculation. So as simple as that. If we don't have fundamentals backing up that asset, then we can't calculate what it's worth. We can't buy with the margin of safety. We can't do all these things that would put it into the investment category, where we can, have a reasonable idea of what the long-term returns are going to be. We just don't know. So that's the first one. The second one I'm going to put into that category is cannabis stocks. So this is getting a little bit more towards investing. It does have an actual business behind it and all that kind of stuff, but it's still certainly a speculation in my mind. So we saw that cannabis stocks went down and down and down pretty much right throughout 2019. And that's a pretty common occurrence with these super speculative investments. And the reason why it is speculative is people aren't paying an appropriate price for that business. Over the long term, we'll see perhaps these prices are really cheap today. But there's a lot of future expectation built into some of these prices. So the best way I like to think about it is, if you think of buying stocks and buying, ownership in a business, which is what you're doing when you're buying shares, you should focus as much as you can on buying it like a business, or like a farm, or like a rental property, or any kind of asset that you can really get your head around what that maths might look like. So with a rental property, for example, you're looking at, how much rent am I going to be able to get in each year? What's the expenses going to be? How much am I going to have to pay on my mortgage? What am I going to have to pay typically each year for maintenance, taxes, rates, all these sorts of things, and you can get a good handle on how much cash that rental property is going to leave in your pocket each year, and then from that you can pay an appropriate price. So if a rental property produces $30,000 a year for you in profit, you're probably not going to be willing to pay $50 million for that house. That's not a particularly good yield on $50 million, but you may be willing to pay $300,000 or $400,000, for example, to get an 8 to 10% return, somewhere in that ballpark. So that's the way I like to think about businesses as well. And with the cannabis stocks of the world, we were seeing some crazy valuations. We had companies that were producing, in the singles or tens of millions of dollars in revenue, not profits or earnings or free cash flow or anything like that, just straight up revenue and sales. And a lot of companies were losing money on that amount of sales. So we had people, we had companies trading for, making $10 million, say, in revenue, and they were trading at like billions of dollars market cap in the stock market, and that is extremely speculative. That they may justify that valuation at some point by growing and earning a lot more cash in the future, but right now they just don't. And we saw that hit investors pretty hard if you were in those cannabis stocks over the last 12 months. So that's another example of a speculation. I want to get into the third example, and we're sort of creeping closer and closer to what I would call an investment here. So with Bitcoin, 100% as speculative as it gets. With the weed stocks and the very highly valued stocks, still speculative, but there's some sort of they're actually making sales and bringing in some sort of money. The third one, and this is probably going to be a bit of a controversial one, but bear with me for a sec here. This company is Amazon. So I am sure that you are all familiar with Amazon, and a lot of people, even value investors, to be honest, would call this one an investment. And I think it certainly has the most merit out of all of the three so far. So it can certainly be an investment if you believe that Amazon is going to continue to grow at 10 or 15 or 20% per year, for example. What really holds me back personally from investing in something like Amazon is the huge multiple that's put on the company. So I'm going to put up a screenshot here of the current PE ratio, just as kind of an easy example of what kind of future expectations are built into this company, what kind of multiple they're trading at. And I think Amazon actually has a very, very good chance of growing into that valuation, doing very, very well in the future, and providing a more than adequate return. I don't think there's any... I think there's a very good chance of doing that, basically. Where I stumble with Amazon is with the downside. So if we have... Amazon is a very complicated company, I'll give you that. But if we have, a lot of competitors come in the cloud computing kind of area, if we have other e-commerce players come in and continue to grow and be able to drive their costs down as well, I see a lot of potential competition in some parts of the Amazon business. And when you're trading at a huge multiple, there's potential for downside. So that is something that I would actually tend to still put a lot of times in the speculation category. A lot of people will disagree with me there, and I don't blame you for doing so, to be honest. It's a bit of a blurry line kind of one. You've got a really good business that's compounded at massive rates for a long time, but it's now at the point where it's trading at quite a high valuation on the surface of things, and there's potential at least for a lot of downside. So that is some examples of speculations. And And so let's just talk through some examples of investments and some of the ways that I like to think through that. Okay, so let's talk through examples of what Ben Graham and Warren Buffett will class as investments. So the first one we've sort of already talked about with the rental property example, and basically any situation where you're following those kinds of mathematics, and you're seeing that there is a very high chance for an adequate return and pretty limited downside because the maths providing that return is so favorable. That's basically what we're looking for with anything that would put in the investment category. So just to give you a couple of examples of that, I've got a video on the channel, which is I think the most popular video now, around calculating an intrinsic value for Apple stock. And if you were to run that type of valuation on any sort of growing company, you would come up with an intrinsic value, and then we also talked about margin of safety and doing those sorts of things. Essentially any business where you can buy at that margin of safety price, I would go ahead and call that an investment. The only caveat to that is if you're using an extremely high growth rate. So if you're assuming that a company is going to grow at 20 or 30% a year for the next 10 years, that's getting a bit more speculative. But if you're using relatively conservative estimates and then being able to buy at a big discount to whatever intrinsic value comes out of that calculation, I'd call that an investment every day of the week. So that's the first one, alongside the rental property example as well. The third one I want to give is a company I've spoken about before, and this is one where the maths is so compelling that you can do this in your head. So this is a company called IPSCO, and it's a steel, tubular steel sort of manufacturer that Monish Pabrai invested in several years ago, I think in 2002, 2003, and this is probably one of the more extreme examples you'll get of very limited downside, so safety of principle, as Ben Graham would say, and an adequate return is pretty much guaranteed with this one. So basically the situation with IPSCO is the steel industry is very cyclical, so the price of steel companies and steel stocks can get beaten down pretty aggressively from time to time. One of those times is probably right now, actually. And IPSCO was an interesting example because the clients that they were providing this tubular steel for had actually got some big projects kind of lined up, and they essentially wanted to lock in a lot of their costs associated with these projects. So what they did is went to IPSCO, the steel company, and they locked in their steel prices. And what that allowed the customer to do that was purchasing the steel was to have, guaranteed expenses. They knew exactly what this project was going to cost. And for IPSCO, they knew exactly what their revenues were going to be and their cash flows and so on were going to be for the next couple of years. So in terms of the numbers, IPSCO basically locked in $15 a share in free cash flows for the next 2 years. They also had no debt, and they had $15 in cash just sitting on the balance sheet, in the back. So all up, you've got 15 in cash, no debt, so there's no adjustments or anything we need to make there. $15 in cash, you're going to have $30 worth of free cash flow, again showing up in cash over the next 2 years. That gives you $45 in total. And the stock was trading at $45 a share. So the real big question with IPSCO is what's going to happen after year 2. Like I said, it's very cyclical, and there was a chance that earnings could go way down or even go negative. But there's a lot of downside protection if you're buying something for 45, and the cash flows that you're going to get in the next 2 years are also going to be 45. So very little downside and a great chance of, like Ben Graham would say, an adequate return. And what ended up happening with Monish Pabrai is IPSCO actually went out, Monish bought the stock, IPSCO went out about a year later and actually locked in another year of revenue, so they had a third year of these $15 of earnings, and instantly the stock basically shot from about 45 to 90, so he had a double. And then a few months later, the company got bought out for about $150 per share was the offer that went through. The stock basically shot straight to the 140s, and Monish sold out. So phenomenal returns over just a few years, very limited downside risk, and that is at the heart of what a sort of real hardcore value kind of investment is. So I hope you enjoyed the video. If you did, hit like, hit subscribe. You can watch some older videos over there. Hit subscribe over there if you haven't already. Otherwise, I will see you in the next one. Cheers.